Hello, my name is Elliot Gu. I'm editor of The Energy Strategist as well as Personal Finance. Today I want to talk about kind of an unusual little area of the market, which is initial public offerings, or IPOs. What is an IPO? Well, it's simply when a company that had been a private company files to list for trading on the major U.S. exchanges. So in other words, a private company wants to list on the NYSE or the NASDAQ. The process they go through is what's called an initial public offering. Typically what happens is a few months before the company actually wants to go public, they filed what's called an S-1 registration statement with the Securities and Exchange Commission. This is all freely available on the SEC's website, sec.gov. Part of the S-1 is basically a prospectus, a description of what the company does, how much money they hope to raise in the IPO, how many shares they want to take on offer, whether they intend to pay dividends or not, what's the structure of the company, is it a corporation, is it a master limited partnership, is it a U.S. royalty trust, what's the structure of the company. Now, the first S-1 typically doesn't have a whole lot of detail. There can be, the description of the company will probably be pretty much as it will always be, but there can be a lot of changes. They may not know what their expected pricing point is. They may not know how many shares they want to list. They may not know exactly how much they want to raise. They may not have a really good handle on how much they want to pay in dividends. So over the ensuing 2, 3, 4, 5 months, depending on the company, they'll file a number of S1-As, amended registration statements with the SEC. Typically, you're going to go through several cycles of these amended registration statements. Each one will add just a little bit more detail to the past one about the nature of the IPO. At some point, you'll actually get them filed to list on the exchange. The stock will be sold at a certain price. Then it will list for trading on what's called the secondary market. That's basically when you and I can get into it at whatever price the market will bear. So maybe the company sells 25 million shares at $25 a share and raising money from that. But when it first opens for trading on the secondary market, it opens at $27 a share. And then you can actually get in and buy it. Now, why is this interesting? Well, IPOs have kind of a bad name. The reason they have a bad name is really a vestige of the late 1990s. For those of you who were around investing at that time, you probably remember all the hype around companies like Pets.com. I mean, here's a company whose main claim to fame was an advertising campaign featuring a sock puppet that was basically in the business of selling dog food and things of that nature over the internet. It was kind of a stupid business plan to start with. It never made any money. And it was really one of the only companies I've ever seen list for trading, major companies anyway, list for trading and then go bankrupt within a one-year period. That company went bankrupt, destroyed billions in shareholder wealth. A lot of similar companies came public at the height of the NASDAQ bubble at extreme valuations. 2 or 3 years later, with the NASDAQ obviously way off its highs, these companies were either bankrupt, ceased to exist, or were trading at 70, 80, 90% off their highs. Destroyed a lot of shareholder value. But throughout history, that's not always been the case. And in fact, some of the biggest gains that I've seen in the Energy Strategist over the last couple of years have been from companies that are relatively new to the exchange. I'll give you one angle on this. One angle on this is to look for IPOs that expect to pay dividends or distributions. Now, as I mentioned, when they first file an S-1 registration statement with the Securities and Exchange Commission, they will often offer details like how much they intend to pay in their first year as a public company in dividends. So let's just say it's a $10 stock, and they think they're going to pay $1 in dividends over the course of the coming year. So that's basically a 10% dividend yield. Thing is, when that company first comes public, it won't have actually paid any dividends. It's brand new to the exchange. Typically, a newly public company is not going to pay their first dividend for a quarter or more after it's come public. So 3 months or more after it comes public, it pays its first dividend. Thing is, when you start looking at this company trading, look it up on a site like a Yahoo Finance or a Google Finance or your broker's website, you type in the symbol, you'll see the trading price of the stock, you'll see a chart showing it trading since whenever it went public, and you'll see the dividend listed as a great big fat 0. That's because the broker doesn't anticipate what the company is going to pay. They only look at the history of what they've actually paid. When the company pays its first dividend, I've seen many cases where they say we're going to pay dividends quarterly. They pay, say, for example, that $1 stock, they pay a 25-cent dividend. A lot of brokers will still show that as a 25% or a 25-cent annualized dividend, in other words, a 2.5% yield, instead of a 25-cent quarterly dividend, a dollar or a 10% dividend yield. It can take some time before that shows up on a lot of these brokers' websites and a lot of sites like Yahoo Finance. In the interim period, a lot of people don't even recognize that the company yields anything. I've recommended a company in times in the past, and I've said, you know, it yields 10%, and I've had email from subscribers, I've had email from people watching me on television who've actually said that company doesn't yield 10% because they're looking at their broker's website and the broker's still showing 0. Now the beauty of this is that when they actually start paying dividends, it starts to show up on the radar screen of a lot of investors. Suddenly this $10 company that had 0 yield in the oil business, not that interesting, now yields 10%. It attracts a lot of capital, attracts a lot of money to these investments. Let me give you an example of a company that's due to come public here very shortly, which is a company called Sandridge Mississippian II. It's scheduled to go public in mid-April. By the time you watch this, it may already be trading. Now this company will probably show up at first on most of your brokers' websites showing a yield of 0. But if it's trading, we're expected to trade sort of in the $25 area, that stock in its first full year as a public company is probably going to yield more than 10%. It may very well be a great opportunity to get into that stock on any dip below $24 a share. This is an area where we're seeing a lot of activity over the next few months because there are a lot of IPOs, initial public offerings scheduled to come public, a lot of them in the energy sector, and a lot of them are stocks which are going to pay dividends or expected to pay dividends. So one area to watch very closely, it's something I write about a lot up on investingdaily.com. That's our free website. Even on our free e-zine, I often write about these newly public companies, newly listed companies that pay dividends. Another example is Whiting USA Trust 2. I wrote that up on investingdaily.com. You can check it out there. But the fact is, you want to look at these new companies, these IPOing companies that are scheduled to pay a dividend. If you look at their prospectus, again, a great opportunity to buy them before the crowd catches on to what they're actually offering in terms of yield. Thank you very much. My name is Elliot Gu.